Picture this. You wake up one morning and your phone is already screaming at you. Notifications flooding in faster than you can read them. Breaking news alerts, red numbers everywhere, and the words global conflict plastered across every screen in your house. Your heart is pounding, your hands go cold, and before you have even brushed your teeth, before you have called anyone you love, your thumb is already unlocking your brokerage app, not because you have a plan, but because fear has hijacked your brain and turned it into a machine that only knows one thing: do something. Do it now, do it fast. That moment right there is where most people lose everything, not because war destroys markets, but because panic does. My name is John, and today I am going to show you exactly why, with over 100 years of financial history as proof, and a clear picture of what people who actually build wealth during a crisis do differently. Hit subscribe right now because what comes next could literally be worth tens of thousands of dollars to you. But before we talk about a single dollar, I need to introduce you to the people quietly cheering the loudest every time a crisis breaks out. They're not governments. They're not shadowy billionaires. They're sitting right there in your living room, glowing softly from your television screen. The financial media. And I do not mean that vaguely. I mean it as a cold observation about how their business actually works. When tension spikes, their viewership goes up. When viewership goes up, ad revenue goes up. Your fear is not a side effect of their coverage. Your fear is the product they're selling every single day. The more terrified you are, the longer you sit glued to that screen, and the more money flows into the pockets of people who had nothing to lose when the market opened this morning. So when markets drop 2% on a war headline and the screen flashes global markets in free fall, understand what is actually happening. A 2% drop is a completely ordinary Tuesday. It only becomes free fall because free fall makes you click. The financial media does not just report on your panic, it manufactures urgency around it. It finds the most alarming expert available, puts him on camera for 17 minutes straight, then cuts to a commercial for a brokerage platform that will happily process your panic-driven trades for a modest fee. Every single piece of that machine profits directly from you doing the exact wrong thing at the exact worst moment. Now let me tell you about two people. Mark is a smart guy with about $40,000 in index funds and a habit of leaving financial news running in the background a little too often. When a major military conflict broke out in early 2022, Mark sat in front of his television for 3 straight hours, heard the word crisis approximately 47 times, and sold everything by 9 in the morning. Then there's the other guy. Same portfolio, same morning, same notifications. But instead of turning the volume up, he looked up one single data point, that the S&P 500 had recovered from every major conflict since the Second World War within an average of 47 trading days. He put his phone face down on the counter and went to work. Everything that follows is the story of what happened to their money, and the gap between them is going to make you genuinely angry. Not at Mark, at the system that spent years convincing him that selling was the smart move. Here's the data point the financial media will never lead with, because the moment they say it, your anxiety drops and an anxious audience is worth more to them than a calm one. Markets do not die in wars. They dip, they shake, they panic for a few weeks, and then, almost without exception, across 110 years of documented history, they climb. The Dow gained 50% during the Second World War, 60% during Korea, 27% during Vietnam. The S&P 500 has delivered positive returns in the 12 months following 73% of all armed conflicts since 1945. Think about what the market has already survived: 2 world wars, a nuclear standoff, a full pandemic that shut down civilization, multiple political assassinations, a debt ceiling crisis that nearly destroyed financial confidence without a single bullet fired. At this point, the market is the most resilient thing on earth, and it keeps proving it. Here's why. Wars are, economically speaking, the most aggressive government spending programs in human history. The moment a country goes to war, it spends without a ceiling. Weapons, fuel, food supply chains, logistics, medical equipment, communications infrastructure. Every single category flows directly into the earnings of publicly traded companies. The government becomes the largest customer on Earth overnight, and it pays whatever the invoice says. That money has to go somewhere, and it goes into earnings. The investors who came out worst in every major conflict were not the ones who held. They were the ones who sold, ran to cash, and watched the recovery happen without them, while that cash quietly lost value every week. Here's exactly what happened to Mark. He sold his $40,000 at 9 in the morning on the day the invasion began. The market fell 2.5% that morning, and then by the close of that same day, it had already recovered and closed 1.5% higher than it opened. Mark missed the same-day recovery. He sat in cash for 4 months. By the time he felt calm enough to get back in, he had missed the best stretch of returns, paid capital gains taxes on the sale, and watched his purchasing power quietly evaporate. The financial news channel he had been glued to the entire time ran brokerage advertisements in every single commercial break. The other guy did nothing. He kept his automatic contributions running, and then he made specific, deliberate additions to his portfolio in a very specific order. But before I share those, I need to say something important. You can know every single fact in this video and still make the wrong call. Because when the moment comes, the wrong decision will not feel like fear. It will feel like clarity. The market is falling. The news is terrible. Everything feels uncertain, and selling will feel like the rational adult thing to do. You'll hit the button and feel a wave of relief, and then the market recovers. It always does. And you'll be on the sidelines holding cash that is losing value, telling yourself you'll get back in once things settle. And every morning your brain gives you the same answer: not yet. Once there's more clarity. By the time it feels safe, the recovery has already happened without you. JP Morgan tracked this precisely. $10,000 left untouched in the S&P 500 from 2005 to 2024 grew to $71,000. Miss only the 10 best trading days in that entire period, and you end with $32,000. Miss 30 days, and you're essentially at break-even for 20 years of waiting. 7 of the 10 best trading days in any period happened within 2 weeks of the 10 worst. The crash and the recovery are almost the same event. The media covers the crash in breathless detail. They barely mention the recovery, because recovery is good news, and good news doesn't sell. So here is what needs to happen, in the exact order it needs to happen. The foundation is liquid cash, 6 to 12 months of living expenses, and nothing more. Before a single dollar goes into any investment, you need 6 months of expenses in a high-yield savings account or government money market fund, and $2,000 to $5,000 in physical cash at your actual house. When Russia was cut from the global banking system in 2022, ordinary people woke up to ATMs that simply did not work. Not because their money was gone, because the digital infrastructure that moves it was switched off. Physical cash for a few weeks of basic expenses is not extreme. It is a simple hedge against a short-term banking disruption. But here is the critical part. That is where you stop with cash. Every dollar beyond your emergency buffer sitting idle is silently evaporating while real assets climb without you. Build the floor. Stop there. Move forward. Next is gold, 10 to 15% of your investable money, but not for the reason most people think. Most people's instinct is to buy gold now because the world is ending, but that instinct points you toward the right asset at completely the wrong time. The people who bought gold at its 1980 peak during geopolitical fear waited 26 years to break even in real terms. The pattern repeats every crisis. Gold spikes on fear and gives back the premium once the worst case does not materialize. Gold is best owned before the crisis is on the front page. Right now, gold is holding strong not because of fear, but because central banks have been buying over 1,000 tons annually since 2022, the highest levels ever recorded. That is not panic buying. That is long-term institutional repositioning by the people who manage the wealth of entire nations. Keep a small slice in physical coins, not because civilization is ending, but for the realistic scenario where digital payment infrastructure goes down for 2 weeks. After that, defense, 10 to 15%. This is the trade wartime history hands to patient investors every single time, and most people never take it because it feels uncomfortable. But look at the data without flinching. Raytheon gained 37% in the single week after the September 11th attacks. $10,000 split across the top 5 defense contractors in September 2001 was worth $97,000 by 2021. In 2022, while the S&P lost 18%, defense outperformed by 28 percentage points. European defense stocks surged 260% from early 2022. The sector is sitting on order backlogs that would take years to clear, even if every conflict ended tomorrow. This is not a short trade. It is a decade-long structural shift that conflict accelerated but did not create. Then energy, 10 to 15%. When conflicts flare near critical supply routes, the script is always identical. Supply gets threatened, fear drives a premium, and energy companies generate extraordinary cash. In 2022, when the broad market lost 18%, energy gained 64%, an 82-point gap in a single year. And while that was happening, the financial media was almost entirely focused on the tech sell-off. They were not wrong about tech. They simply forgot to mention the sector quietly up 64% in the same year. Consumer staples deserve another 10 to 15%. People do not stop buying medicine, cleaning products, and food during a war. They cancel vacations, they skip restaurants, but human beings require basic household goods regardless of what is happening geopolitically. When the S&P dropped 17% through August 2022, a basket of consumer staples lost only 4%, 13 percentage points of protection with a dividend yield on top. Nobody brags about it. It always gets the job done. Then inflation protection, 5 to 10%, and a warning. During the Second World War, U.S. government treasury bonds lost 67% of their real value. The classic safe haven was one of the single worst places to have money during the entire war, because wars are deeply inflationary. Governments borrow without limit and quietly inflate obligations away over time. Standard bonds get destroyed in that environment. What works instead is inflation-protected securities that automatically adjust when prices rise. Avoid long-duration government bonds entirely during wartime conditions. And the one thing you absolutely do not touch, your broad index funds. Data across every major conflict of the past century found that large-cap stocks returned 11.4% annually during wartime, higher than the 10% peacetime average. Keep contributing automatically. A downturn is the single best moment to maximize tax-advantaged contributions. You're buying growth at a discount. Don't check the balance for 6 months. You'll thank yourself. Now, the numbers, because numbers are the only thing that makes this real. Mark sold $40,000 in index funds the morning conflict broke out. He sat in cash for 4 months, paid capital gains tax on the sale, and re-entered the market after energy had already run 64% and defense had already outperformed by 28%. He captured none of the upside and locked in the downside permanently through the tax bill. His $40,000 4 years later was roughly $48,000. The other guy's original $40,000, combined with automatic monthly contributions made while the market was down, plus targeted positions in defense and energy, was worth roughly $91,000. Same starting point, same news alerts, a $43,000 difference. And understand this clearly, he didn't win because he found some magical stock. He won because while Mark was sitting in cash, convinced he was being cautious, he was steadily buying quality assets at a discount every single month. He bought the fear, Mark paid for it. So here we are, back to that morning. Your phone is going off every 30 seconds. The screens are all red. Some analyst with perfect hair is explaining with total confidence why this time is completely different from every other time the market has recovered. The person without a plan sells everything, feels briefly smart, and spends the next year watching the recovery from the sidelines while the channel that scared him to selling runs ads for the platform that processed his trade. The person with a plan looks at the structure he already built, puts the phone down, and makes a cup of coffee. One of those people builds real wealth. The other one funds the system designed to stop him from doing so. The time to become the second person is right now, not when the missiles are already flying. Right now, while you're calm, while you can think clearly before the next headline turns your judgment into panic. If this changed the way you see any of this, hit like and subscribe. It's free, it takes 2 seconds, and unlike everything else competing for your attention today, I don't make a single cent more when you're afraid.